street fight. Representing the Bulls, we have Mark Martiak, who's senior wealth strategist with Premier Wealth First Allied Securities. And for the Bears, Dan McMahon, Raymond James, director of equity trading. So we need to go macro here, guys, first, because we just looked very micro at Groupon. But okay, Dan, I'll begin with you because you're bearish here. Had I listened to you being bearish over the past even just 3 months, I might have lost money. I mean, that's my concern here, that Wall Street continues to climb the wall of worry and people miss out.
It has, and we're through earnings season, and I think you've seen a bit of that as a reason behind part of the rally is money managers who have a pile of cash on the sidelines thinking they might be missing something, and so having to put money to work. You've also seen some short covering. However, it's coming amidst, the catalyst of late was the earnings season, and we saw a very disparate group of winners versus losers. But all in all, it was on the positive, and you also saw some positive developments, albeit maybe just saber rattling or a lot of talk coming out of Europe. Now that that's all behind us, what's the next catalyst to take us higher? And we're a little bit range bound still.
All right, Mark, let's bring you in. You are the bull. You say you see the S&P at, what, 1,500 before the end of the year? My question is why? Because the guidance I've seen from corporate managers doesn't really echo that.
Well, I believe corporate cash is going to come off the sidelines very, very shortly. And in fact, Dan made a point about cash being on the sidelines. There's $5.8 trillion in money market funds right now and CDs. And I'm advising my high net worth and ultra high net worth clients who have any cash on the sidelines that the market is in the process of consolidating for a second half rally. So I am bullish, but I also like fixed income. The new flight to quality asset class is investment grade corporate bonds. Year to date, $69 billion have flowed into investment grade corporate bonds, while $2.1 billion has flowed into U.S. Treasury bond funds and ETFs. So I'm advising a diversified portfolio to mitigate the risk, and that's headline risk specifically.
Okay, so there's a teeny bit of caution in there. Dan, just because you're a bear doesn't mean you're not finding ways to invest this money. What do you like right here?
I think he sounded more bearish than I did, for crying out loud. Given the low rate environment and a slow to very moderate growth at best, we're advising people to buy yield. Real estate we like, MLPs on an infrastructure play.
MLPs, we should just let people know, master limited partnerships, they have a high dividend. These are more energy deals.
And they do have exposure to energy, which we are very bearish on the sector, given we think that there's oversupply of the commodity. But we're also saying, avoid Europe at all costs, because while they're talking big, they have not come up with a solution yet, and it's not going away.
Mark, you like real estate as well. How do you play that, and do you think we're already off the bottom in real estate, as so many people are starting to predict?
Well, we are starting to come off the bottom. I've seen that trend occur over the last few quarters. You play it with ETFs, you play it with mutual funds, you play it with REITs, both traded on the exchange and non-traded REITs.
Okay, but overall, let's get a wider picture here from you guys. And Dan, you were joking that Mark sounds a little bit more bearish than you do, but everybody's got to be slightly cautious going into what we keep hearing about is the fiscal cliff. And now we just had Drew Mattis of UBS saying that'll be like Y2K, much ado about nothing. But when you look at that, are there ways to position your portfolio in advance of even perhaps a little bit higher tax rate for a lot of people?
Well, I'm not a market strategist or a financial analyst, so I wouldn't even begin to tell you how to structure a portfolio given tax changes or fiscal problems that may or may not exist. But, we take a very long-term view perspective of the market, and so we're just stay the course and stick to fundamentals, buy dividend, and, the market's probably a little bit overpriced here, may have gotten a little bit ahead of itself, which you saw the pullback today in the S&P and the Dow. So, stay the course, but be cautious at best.
Mark, I would suspect you have the same advice, correct?
I do. However, when it comes to asset allocation, it all depends on everyone's individual risk tolerance and time horizon. So I'm advising every different client of mine, let's take a very careful look. If we have money on the sidelines, let's decide how we're going to tactically take advantage of opportunities. But long-term, strategic asset allocation, being paid to wait. I like the paid to wait theme. I think it's very, very important in the form of dividend income and bond interest income.
Well, it's worked pretty well over the past several months. Mark Martiak and Dan McMahon, good to see you. Thank you so much.
Thank you.